interest rates dropped a little bit over the last 2 weeks. What? You say, that's right. They have taken a couple dips down in two different times over the last 2 weeks. Take a look at this chart. So it does show an incline or a steady increase over the last couple years, but you can see, especially at the end, how it has dipped down. And this interest rate dip is super interesting and great to talk about because there's a lot of hype in the news and in the media on interest rates going up, up, and up and showing no signs of stopping. So this shows a little bit of signs of stopping. Let's talk about that in greater detail. So it is true that the Federal Reserve met and they said we are going to increase interest rates at 0.5 point increments at various times this year, more than a couple times throughout the year. And by doing this, our goal is to slow inflation down. Well, when they do this, it causes the market to understand what's going on and provides a level of certainty. The market loves certainty. Certainty provides stability. If you know where you're going, you have a chart for where you're going, you can be calm, sit back and enjoy the drive, right? But when you don't know and you're not being told what's going to happen, then that causes uncertainty. So these interest rate increases on the short-term rates of return that the Treasury bill has increased has caused a level of certainty and has caused an inflation, a leveling off a bit on inflation. These two things are causing better certainty in the environment and in the market and causing interest rates to level off a bit. Furthermore, it should be known that interest rates, the 30-year mortgage interest rate is not tied into the Treasury bill, which the Federal Reserve sets, but it's more determined by the 10-year bond. So the sell-off of the government selling off bonds has caused interest rates to go up. At the same time, the inflation bond, which I talked about last week, is bearing a rate of return of 9.62%. So what does that mean? That means that more and more American people are buying those bonds. That's right. We're taking on that risk ourselves and buying those inflation bonds at over 9% interest. And the purchase of those bonds is causing these interest rates to simmer a bit. I love to hear that because I'm done with the sizzle and I love a little simmer. So I'm excited about that, and I'm excited to see what interest rates are going to do over time. The next chart that I want to show you talks more about what the 30-year mortgage interest rate has done over the last 50 years, from the 70s until 2021, 2022. And as you can see, at the time that interest rates were at 18% in the 80s, did we have a housing market crash then? No, we did not. No housing market crash, and interest rates were at 18%. Did slowing buy? Did buying slow? Yeah, it sure did. Most definitely buying slowed down. But did it cause a crash? No. So interest rates are not indicative of a housing crash. In fact, when we had our housing crash, the interest rates were below that line, and the average interest rate over the last 50 years is 7.8%. And we're well below that. We're well below 7.8% on a 30-year mortgage interest rate. So rates are below the average over the last 50 years. Number two, when we had the market crash, interest rates were below that 7.8% as well. And when interest rates were through the roof, we didn't have a housing market crash. So interest rates are not tied into a housing market crash. I have bad news for you. The other thing you should know is interest rates, when they increase, they typically increase for a period of about 18 months before they come back down. So over the last 2 years, we've been seeing this increase. And so it could be time for a slowing or decrease. I'm not saying that it's certain, but I am showing there's signs of slowing, and there's actually signs of cusping over that interest rate that was cusping at 6% is cusping back down. So pretty interesting information, right? So the key is, don't believe everything that you hear and you read. Don't go selling your primary residence to live in an apartment where you're going to spend extra money on rent. Don't go selling your primary residence or an investment property, dump it in the stock market because your investor tells you to do that. Take things slowly. Whatever's built right is built slow and steady. Take a look at all the signs and see what that leads you to do. The other thing I'd like you to know is that with these interest rate increases, so a $300,000 home has a payment of about $1,668 principal and interest that's about $360 more than it was, let's say, 1 year ago. So $360 a month, is that a deal buster? Does that mean that you're not going to buy a house at $300,000 because the payment is an extra $360 a month? No, probably not. Especially as you and your family have needs. You might have needs to have a mortgage, to have that housing. You might have a need to do an upgrade to your home, to increase your square footage. Maybe you have a growing family. Maybe you need to do the opposite and you have an empty nesting home and you want to decrease housing. People have reasons for needing housing and for buying homes. And what I'm seeing right now is that rents are way higher than housing prices and housing mortgage payments. So even in the environment that you choose to say, I'm going to sell my primary residence, I'm going to live somewhere cheap and wait for this housing bubble, this housing crash, that may not happen. And it may not happen for years and years down the road. It will definitely, I could see how as interest rates continue to rise, if they do, I could see how housing will slow down, right? Because the buying power decreases. Let's say that I am capped and I'm making the same money that I did 2 years ago, and that house payment is going to cost me $360 more a month. If I don't have the budget for that, if I'm not making more money, then I'm not able to afford that house payment. But the truth is, with these inflation prices, people are making more money than they did just 2 years ago. So the truth is, you're probably able to afford that same house payment that has had that increase because your wages have gone up. Wow, that was a mouthful, right? We talked about a lot of different things. I think overall it's important to understand the market, understand that interest rates are in the 5s, big deal. They're still quite a bit lower than the average of the 30-year mortgage rate over the last 50 years. And it's important to know that we are not in a housing market crash, and apparently it doesn't appear that we're in a bubble. There might be some sort of correction that is coming, and that will be determined by these interest rates and where people feel the climate of their comfort level is. More things not come from how people feel about the market. So if you feel that the market is terrible and you listen to the media and you start selling off your stocks, you and multiple millions of other people, that could cause a disruption in our economic system. This is Dawn Connors at Mortgage One. Thanks for watching.